Now moving on to the fifth scenario with our business, the ice cream shop. And before we get into this scenario, I want to give a heads up that there's going to be a couple of new concepts in this scenario that I'm going to introduce and talk about, expand on. I'm also going to introduce the fourth financial statement. So notice we've covered three of the four: balance sheet, income statement, statement of retained earnings. At the end of this scenario, I'll introduce the cash flow statement and explain intuitively why it is used and how it all ties in with these transactions. And then also at the end, what I'm going to do is bring back the equations that I've been talking about. So with the income statement, I talked about how revenue minus expenses equals net income. With the balance sheet, how assets equals liabilities plus equity. We also talked about that statement of retained earnings. So beginning retained earnings plus net income minus dividends equals ending retained earnings. I'm going to sort of combine all of them and show you how you can work through these transactions only using the equations. Notice we've been showing everything visually so far with these financial statements, but you can also show everything through equations. So I'll show you at the end of this scenario how to do that. So let's see what we have here. So in November 2012, you bought 25 kilograms of ingredients for $1,000. You then used 15 kilograms of the ingredients to make $7,000 in revenue. You also had rent, interest, and utilities to pay at $2,000, $100, and $400 respectively. In addition, you paid down the loan and paid yourself a dividend of $700 and $900 respectively. So the $700 was used to pay down the loan. The $900 was the dividend that you paid yourself. And all of these were cash transactions. And then also notice how I have the balance sheet from the end of the last period. Last period we did October in that fourth scenario. So notice this is the balance sheet at October 31st, 2012, which is the same as the balance sheet at the beginning of this period, so November 1st, 2012. Notice that all of these transactions coming up are taking place in November, so that's the balance sheet at the beginning of the period. So to start this fifth scenario off, I initially actually want to focus on just the first two sentences. So notice that I rewrote the two sentences here, and I'm going to be focusing on them separately because there's a lot going on here. There's going to be some new concepts that I'm going to introduce. So let's reread what's going on. In November 2012, you bought 25 kilograms of ingredients for $1,000. So I put that here. That's one transaction. And then you used 15 kilograms of those 25 kilograms that you bought to make $7,000 in revenue. So let's go through each of these separately, starting with this one, and see how everything is affected. So we bought 25 kilograms of ingredients for $1,000. So initially, when you're reading this, you may think that it makes sense to take this $1,000 that you're spending on these ingredients and put it as an expense on the income statement. Remember, the income statement is revenue minus expenses equals net income. So just reading this initially, this ingredients for $1,000, that sounds like an expense, but it's actually not an expense. It actually first gets recorded as an asset. And so what's going to happen is if we go back to this balance sheet at the beginning of the period, so if we redraw the left side, so we'll have cash of $10,100, and then we have the machine for $8,000. What happens after this transaction, let me actually just put a line here, is that we're spending $1,000 cash. Remember, all of the transactions in this fifth scenario, they're all cash transactions. So we're spending $1,000, so that means our cash balance is going to go from $10,100 to $9,100. But these ingredients here, they're not an expense. They actually become an asset first. Now, why is that? So these ingredients go under assets on the balance sheet. Why is that? Why didn't we take this $1,000 and make it an expense on the income statement? We put it on the balance sheet instead. Well, it's a good question, and it's an important one. And what we have to do is we have to differentiate between an asset and an expense. And in your textbooks, and your prof is going to go more into detail than I'm about to go with these. But the biggest key difference between these two, the way I like to look at it, think about it simply, is an asset is going to be used in the future to generate revenue. While an expense is used now to generate revenue. And when I say now, what I really mean is used in this period. Right? But I kind of put now because it's easier to compare to the future. But now really means at whatever period that you're looking at. Right now we're looking at November. So an asset's going to be used in the future to generate revenue, and an expense is used now to generate revenue. That's how I like to differentiate it in my head. And you're going to see more specific definitions for these. I'm going to come back to these definitions and expand on them once we get more in detail in differentiating between these two. And there's going to be lots of scenarios where we're going to have to. You may see assets be defined as like an economic benefit in the future, right? Another word, if it's going to be used in the future to generate revenue, you'll see the word owned being used for an asset. An asset is owned right now and it's going to be used in the future. Versus an expense, if you're using it now to generate revenue, you'll see words such as consumed come up. Right? It's being consumed right now in this period to generate revenue, or incurred is another popular term. Okay, we're incurring expenses. We're using the expenses now to generate revenue. So knowing that, not getting too much into detail, again, the most important difference, future, asset, now is expense. So taking that, relating it back to this, notice that in this transaction, let's ignore this second one. If we're just looking at this, we buy 25 kilograms of ingredients for $1,000. Now, are those ingredients going to be used in the future to generate revenue, or are they being used now to generate revenue? Well, these ingredients would be used now to generate revenue when the ice cream is actually sold, when the ice cream is handed to the customer. Then the ingredients in that ice cream are also handed to the customer. But notice now that when we bought these ingredients, they're not being used now yet, right? They're sort of being stored and they're going to be used in the future. And we don't know how many, at this point, remember we're ignoring this, we don't know, are these ingredients going to be used, all of them, are they going to be used in November? Or is a portion going to be used in November, and then a portion in December, and then a portion in January? We don't know exactly when these ingredients are going to be used to generate revenue, right? So for now, just with this transaction, they're going to be used in the future to generate revenue. And because they're going to be used in the future, we have to categorize the ingredients as an asset. And putting the ingredients on the balance sheet, another word for this is capitalizing the asset, right? So sometimes you'll see, do we have to capitalize something or expense something? And again, it comes down to, is it going to be used in the future? If it's going to be used in the future, it's an asset, so we capitalize it. We capitalize that transaction. If it's going to be used now, then we incur that expense now. And if you notice, if you look at all of the assets in our business, notice that they're all used in the future. Notice cash It's not being used now. When you have cash, that's going to be used in the future. Cash by itself is useless, right? It's not being used now to generate revenue. You got to take that cash and put it towards something in order to make more money, whether that's buying some kind of asset that's going to make you more money, maybe putting it towards marketing, whatever it is. But cash by itself, it's not being used right at this moment to generate revenue. It's going to be used in the future. So that is an asset. The machine is actually a combination of both. Notice that when you think about when we initially bought the machine for this $8,000, when we initially bought it, it isn't being used yet. It's going to be used in the future. And so it became an asset. And let's say that we have this machine, $8,000 asset, and let's say that it's going to be used for 10 months. Right, let's say that's the life of the machine. Well, what we can actually do with the machine is that every month that passes by, we can depreciate it. So we can actually take an expense on this. So one way to do it is to do it by proportion. So notice that 1 month out of 10, that's 10%. So it's like we're using now, in 1 month, 10% of this machine. So we can take an $800 expense on it. And then that machine would go down in value to $7,200. We're going to have more examples in the future on that when we get to how to deal with fixed assets and depreciating and the different depreciation methods. But for now, we're not doing this. We're not taking any depreciation on the machine. Let's pretend that this machine is going to last forever. So it's going to be always, it's always going to be able to be used in the future, right? So we just keep it as an asset for now. So initially, it becomes an asset, and then you'll see you could take depreciation on it and then expense it. But for now, it's just an asset. And then these ingredients here, they're not being used yet, right? We haven't made any revenue. We haven't sold any ice cream. So these ingredients are stored right now within our company. So they're going to be used in the future. So they get used as, they get classified as an asset. That transaction is capitalized. So it goes on the balance sheet. And notice that this here is the left side of this balance sheet. So the balance sheet went from this at the beginning of the period to this. This is the left side, the assets, after this transaction. And notice that that right side, it stayed the same. Nothing changed on the right side. So we still have the loan, still have the capital, still have the retained earnings with those same amounts. And notice that when you add all those up, 18,100. When you add up all of these, 18,100. So both sides are balancing after this transaction. Okay, now moving on to this transaction here. So now what it's saying is that we use 15 kilograms of the ingredients to make $7,000 in revenue. So notice 15 kilograms of the 25 kilograms that we bought, right? And the fact that it's being used now in this period in November to generate this $7,000 in revenue means this 15 kilograms of the ingredients we can classify as an expense because it's being used right now to generate revenue. But notice that this 15 kilograms, that's not the full 25 kilograms that we initially bought. And so what we have to do is we have to figure out how much of these ingredients can we expense. Okay, because it's only 15 kilograms that are being used to generate this $7,000 in revenue. So the way we can do that, get that dollar amount, is we can figure out first, what did we buy? How much did the ingredients cost per kilogram? So we bought 25 kilograms for $1,000. When you do that, you would get $40 per kilogram. So then these 15 kilograms that are used, what's the dollar amount of that? Well, when you multiply these, that would end up being $600. Another way to do it is 15 kilograms out of 25. What percent is that? 60%, 0.6. So then 0.6 you can multiply by the 1,000. Only 60% of the ingredients that we bought are being used in this period. So only 60% of the ingredients can be classified as an expense. Only 60% of these ingredients that we bought are being consumed. So then 60% of 1,000 is $600 as well. That's another way to do it. Okay, so we know $600 of the ingredients are being used. So what's going to happen? Let's start with the balance sheet. So we got the assets here. Actually, you know what? Let's do the income statement. So I'll do the income statement here. So notice that we made $7,000 in revenue. Let me classify this. And notice that the ingredients that we can classify as an expense is $600. Now, there's going to be other expenses like the rent, the interest, the utilities that was in this scenario. I'm going to bring that back after and fill this income statement in more with more expenses. But for now, with these two transactions, let's just pretend that this is all that's happening. So notice that with these, what's going to be our net income? It's going to be $6,400. Right, $7,000 minus the $600 of ingredients. And so how is that left side of the balance sheet going to change? Well, notice that these are all cash transactions. So this $7,000, we are getting cash for that. And notice that this $600, these ingredients here, this expense, we're not paying $600 for that because we already paid for the ingredients initially for $1,000. And so that there is not going to be affecting the cash. Remember, our cash got affected by this $1,000 already. It went from $10,100 to $9,100. So the only thing that's going to make the cash go up in this case is this $7,000 over here, right? So 9,100 plus 7,000, that would give us 16,100. Notice the machine did not change. That's still going to be 8,000. And now, what's the ingredients on the balance sheet going to be? What's that amount going to be? It's not going to be 1,000 because we used up 600 as an expense, so there are $400 of ingredients left at the end of the period. Because remember, 60% got used. Right, so now notice that we're going to have a different total on that left side of the balance sheet. So if we add everything up, we would end up getting 24,500. Okay, so now what's going to happen on this right side of the balance sheet? Because notice the right side is 18,100. So it's not balancing with this. Well, notice that this net income, where does the net income go to? It goes to retained earnings. Okay, so this 6,400 is going to flow into this retained earnings, and now the retained earnings is going to become 9,500. 3,100 plus the 6,400. So now this is going to be the right side of the balance sheet. I kind of wrote it here. I'm running out of room here. And then this is going to be the left side. And notice when we add all of this up, it's going to add up to 24,500. When we add up all of these assets, 24,500. Right? So notice that, again, only 60% of these ingredients that we bought were able to be expense. And then the 400, remember how I mentioned we don't know how much of the ingredients are going to be used up in which periods? Well, now we know 600 was used up in this period in November, so we could expense that amount because it was used now. And then this 400 is left, which is going to be used in a future period, so we have to keep that as an asset on the balance sheet. And this here, sort of matching this expense to this revenue, it's called the matching principle. And basically what the matching principle says is that expenses are recorded, so these ingredients here, they're recorded with related revenues. So very similar to that definition of expenses that I gave, that you can record an expense when it's used now to generate revenue. So the matching principle, you can match those expenses. We use $600 of ingredients to make this revenue of $7,000. So it matches both of these. We use these expenses to make that revenue. And so we could claim those expenses with that revenue right there. On that same income statement, we match them, right? Expenses are recorded with related revenues. So matching principle, it's basically that right there. Anyway, hopefully you understood that. So what's happening, one more time as a review, this transaction here, these ingredients, they're not being used yet to generate revenue. So we can't classify them as an expense yet. So they get classified as an asset on the balance sheet first. And actually, later on in the course, you're going to see it's not going to be ingredients. I'm just going to keep that for now for this transaction to keep things simple, not confuse you, not bring in too many terms. But really, this is going to be inventory. This is going to be called inventory once we get into more detail later on in the course. I'll keep it as ingredients for now, right? So this would be inventory here as well on that balance sheet. And then this ingredients here, this expense, first off, notice that another point I want to make, I should have maybe named these differently. This ingredients and this ingredients are different. This is an asset, this is an expense, right? So that's another thing you got to differentiate. That's why there's going to be these different terms in the future, just so you don't get confused. It's not going to be ingredients on the balance sheet and then ingredients on the income statement as well, because that could be a little bit confusing. What this is going to be called, any inventory that gets used up as an expense to generate revenue, the term for it is cost of goods sold. And that's an expense that goes on the income statement. Okay, so this would be inventory on the balance sheet, and then inventory that gets used up to generate revenue, it gets transferred to cost of goods sold on the income statement. So they're not going to be named the same thing. But for this example, I just kept them the same. But realize that this here, this 400 is an asset, and then this 600 is an expense, right? And so we're going to go into more detail about capitalizing versus expensing. It's actually a very important topic. We're going to see that we're going to have to capitalize certain assets, stuff like prepaid insurance, prepaid rent, and then it's going to get expensed over a certain period of time, right? Within, in proportion to the life of that asset. And knowing when to capitalize an expense is super important, because there's actually been real world scenarios where this led to a lot of confusion. And a good example of this is the company WorldCom. Used to be a telecommunications company. And what happened was there was a big accounting scandal. And the CEO, I think he got sent to jail for like 25 years. And what happened was that they inflated their earnings or their net income. I think it was like 3.8 billion or 4 billion, around there. If you Google WorldCom, capitalizing expenses, you should see a bunch of articles come up. And that's exactly what they were doing. They were taking expenses, but they were capitalizing them. So let me show you, kind of from a higher level, what happened was, these aren't the actual numbers that I'm about to present, but it's going to give you an idea. So let's say they had revenue of $6 billion, and then they had expenses of $7 billion. So notice that they had a loss of negative $1 billion. And then let's say that their balance sheet, let's say they had assets of 20 billion. They had liabilities of 10 and equity of 10. Again, these aren't the actual numbers, but I'm going to kind of illustrate what happened with them. So this is what their financial statements should have shown here. And more specifically, this income statement should have shown that loss of negative 1 billion. But what happened was they didn't want to show that loss of negative 1 billion. And so what they decided to do was they decided to take a portion of these expenses, and instead of expensing them, which they should have been expensed because they were used now to generate that revenue, they were consumed, incurred, they should have been expensed. I forget what the expenses were, some kind of operating expense. It should have been classified as an expense, but what they did was they took 4 billion of those expenses. So instead of having 7 billion in expenses, they really had 3 billion in expenses. And they capitalized it as an asset instead. So instead of having that 4 billion in expenses, they took that 4 billion and they capitalized it. They kind of hid those expenses on the balance sheet. So that became 24, and that means their equity was inflated by 4 as well. So not 10, but it was really 14. So both sides here balanced. And then notice that instead of having a loss of 1 billion, what it should have been, they really had a gain. They really showed a gain of 3. So it went from negative 1 to 3. So they overstated their earnings. They overstated their net income by 4 billion. And again, what they did was instead of doing this here, because this 15 kilograms of ingredients was used, so it should be expensed, they didn't expense it. They kept those ingredients on the balance sheet at $1,000. And so their expenses were less, right? And it wasn't $600, it was around $4 billion, I think it was. If you Google the WorldCom capitalizing expenses, you'll get the actual number. But yeah, that's basically what they did, right? And so the government finally caught on to that. The SEC finally caught on to that. CEO went to jail for 25 years, and it was a huge accounting scandal. I mean, $4 billion. It's a lot to inflate earnings by, right? So just a real world example of knowing when do we capitalize something, when do we expense something. It is really important in accounting. Now moving on to the rest of the transactions in the scenario, I wrote them out over here. Notice that they're not in paragraph form like they were initially presented. Sort of put them in point form here just to save some room on the whiteboard. And notice that we have the income statement and the balance sheet so far for November after those 2 transactions that we already dealt with the ingredients being bought and then being used. So a couple things I want to mention. Notice this balance sheet, it doesn't have a date here because we're still sort of in the middle of November after those 2 transactions, the 2 initial transactions, and then we still have these remaining. So there's no date on this balance sheet as of now, but in the end, this balance sheet is going to be for the end of November, November 30th, 2012. Also notice how this retained earnings here, the last number we had was the 9,500, and that was making both of these sides balance. Notice that I kept it blank for now because 2 reasons. Number 1, a bunch of these transactions are going to affect that retained earnings account, so it's going to fluctuate. And then number 2, I actually want to get that ending retained earnings amount for November 30th, 2012 from the statement of retained earnings, which I'm going to show you, present it in a little bit. And what I want to show you, instead of taking these transactions and adjusting that retained earnings account every time after every transaction, I want to get that final amount from the statement and show you how we can sort of indirectly get that number and it's still going to make both sides balance. So I'll show you that in a little bit. Let's take care of these first three transactions. Notice that they are expenses, so we can sort of group them together. They're all going to go on the income statement. And then this paid loan here and dividend, when we're paying the loan, that's not going to be an expense, right? That's just going to affect the balance sheet, so that's not going to go on the income statement. And then the dividend doesn't affect the income statement either. So it's only these three remaining transactions that are going to affect the income statement, so I thought I would group them together. So we'll have rent of $2,000. We'll have interest of $100, and then we'll have utilities of $400. Now, going back to that capitalizing versus expensing difference, why do we have to expense these? Why can't we capitalize them like we did with the ingredients? Well, notice that the rent, this rent payment, this interest payment on the loan, this utilities payment, these are monthly expenses. And so they are being consumed right now in this period of November. And so they can't be capitalized. It's not like this rent here that we're paying of $2,000 is going to be used in the future to generate revenue. It's being used this month to generate the revenue. So it has to be expense. Same thing with the interest and then the utilities. And then the next month, there's going to be a new rent payment, a new interest payment, a new utilities payment. And so they get put on the income statement. So if we net all of this out, we're going to get our final net income figure. And when we take 7,000, subtract 600, 2,100, and 400, we would end up getting 3,900. So that's going to be the net income for the period for November 2012. Now, from these new transactions that we added in, the rent, interest, utilities, notice that that's going to affect our cash as well, because we're paying these with cash. We're paying the rent with cash, interest with cash, utilities with cash. Remember at the beginning it said all cash transactions. So if we total these up, these three transactions, it's 2,500. So this cash balance is going to have to go down by 2,500. And remember, this cash balance already took into account the two ingredient transactions, or the first ingredient transaction, that's where the cash was spent, and then it also took into account this 7,000. So we don't have to worry about that. All we have to adjust the cash balance for, this 16,100, is this $2,500 expense. So if we take 16,100, subtract 2,500, we would end up getting 13,600. So that is the new cash balance after these three transactions. Right, so we took care of these. Let's move on. So now we're paying down the loan for 700. So this is a new type of transaction. We haven't done this yet. So when we're paying down the loan, what's going to happen? Well, we know that our cash is definitely going to go down. We're taking $700 and we're paying off this loan. And so initially the loan has a principal of $5,000. That's what we owe. But now we're paying it down by $700. So the loan is going to go down as well. And notice that both of these are balance sheet accounts. So again, as I mentioned, nothing goes on the income statement with this transaction. The income statement is not affected. So the cash is going to go down by 700. So it's going to go from 13,600 to 12,900. And then this loan is going to go down by 700. So from 5,000 to 4,300. Right? So this transaction was only on the balance sheet. And then finally we got this dividend of $900. Now that's going to be paid with cash, so we know our cash balance is definitely going to go down. And what else gets affected by a dividend? retained earnings, if you remember. And actually, I think it's a good time now to make the statement of retained earnings. And the statement of retained earnings, what it's affected by, retained earnings, remember it's affected by net income and dividends. So I'm actually going to erase this income statement here, make the statement of retained earnings. It's for the month of 2012. Remember, statement of retained earnings is for an entire period. It's not like one specific point in time like the balance sheet is. So what happens is we start with a retained earnings amount. And November 1st, 2012, we start at the beginning of the period, which was the beginning of November. If you remember, the retained earnings at the beginning of the period was what? $3,100. And then what we do is we add the net income for the period, which comes from the income statement, so that $3,900. And then we deduct or subtract the dividends, any money that we take out of the business, this $900 here. And the $900, let me erase this. Remember, that's being paid with cash. We're taking out cash from the business, so our cash balance is going to go down by $900. And so this here is going to end up being $12,000. From $12,900, subtract that $900 being paid for the dividend, we get a cash balance of $12,000. And now, what's this final amount that we're going to get? It's going to be our retained earnings amount for the end of the period. So this was the beginning of the period, then we have the changes within the period, and then we have the retained earnings amount at the end of the period, so November 30th, 2012. So we would just net all of this out. So 3,100 plus 3,900 minus 900, that would give us 6,100. And now this amount here flows onto that final balance sheet. And now notice our balance sheet is complete. So we can actually add a date here. This is the final November 30th, 2012 balance sheet. Notice there's no more transactions to take care of. And also notice how both sides are balancing. If we add up all of these numbers, we would get 20,400. And notice when we add up all of these numbers, 4,300 plus 10,000 plus 6,100, which we got from here, notice that that's going to add up to 20,400. So notice that we weren't adjusting that retained earnings account after every transaction. We're more so adjusting the cash balance and any other, like the loan for this transaction. But this retained earnings account, we weren't adjusting after every transaction. We got it from here, from the statement of retained earnings. And notice that even though we got it indirectly, quote unquote, it still makes the balance sheet balance on both the left and right side. And one more thing that I forgot to adjust here in the statement of retained earnings is this title here. Notice that that's not the income statement that we had before. This here is our statement of retained earnings for November 2012. So to summarize everything that has happened, notice that we started with this balance sheet here, November 1st, 2012, which was the same balance sheet at the end of the last scenario, at the end of October. So we started with this here. We went through all of these transactions, which I rewrote here in point form. And then we created an income statement, which is not shown on the board at the moment, but from that income statement, we got this net income amount of $3,900. And then we had the statement of retained earnings, where we added that net income, then subtracted those dividends that were paid, that we took out of the business, that $900. And then we ended up getting our final retained earnings amount, which flowed onto the balance sheet here, the balance sheet at the end of the period, November 30th, 2012. So we went from here, and then to there. Now, one thing I want to mention is, if you remember a couple of videos back, what I said was that if this is a period here, what happens is we start with a balance sheet at the beginning of the period, like this, and then we have a bunch of transactions, like these over here, and we end up getting our ending balance sheet at the end of the period. And I said that these transactions here, they all get grouped on the income statement. That's how I introduced that financial statement, the income statement. But notice that if we look at all of these transactions here, not all of them went on the income statement. I mentioned that as I was making this, as I was going through this scenario. So notice that this revenue went on the income statement. This, the ingredients that were used, that were consumed to generate this revenue, that went on the income statement. The rent went on the income statement. This went on the income statement. And then the utilities went on the income statement as well. But notice that these other transactions, when we bought the ingredients, the income statement wasn't affected. We capitalized those, so only the balance sheet was affected. When we paid down the loan, that didn't affect the income statement, only affected the balance sheet. And then when we paid that dividend, that only affected the balance sheet, the cash account, and then that retained earnings account. But notice that almost all these transactions, except for this one, except for that ingredients expense that got incurred, all these other transactions, notice how they all used cash. And if you remember, when I was going through this scenario, I kept on erasing this cash account a lot of times and adjusting it, right? When I was going through each transaction. And so because of all of these potential cash adjustments that we're making with these transactions, what external users want is actually a more detailed statement showing how that cash account changes. So how the cash goes from 10,100 at the beginning of the period to 12,000 at the end of the period. So I mentioned how users want to see how that retained earnings amount changes from the beginning of the period, 3,100 right here, to the end of the period, 6,100 right there, and that's affected by the net income and dividends. Well, they also want to see how that cash account gets affected from the beginning to the end in more detail. And so what I'm going to do now is I'm going to introduce a cash flow statement, show you how to make it. Now this is going to be very general. We're going to get more into detail with a cash flow statement. There's actually two ways to do it. There's a direct method, there's an indirect method. The method I'm going to show you now is going to be the direct method. But even with the direct method, we're going to get into more detail. There's going to be more categories, etc., etc. But in general, a cash flow statement, what happens is we start with our beginning cash at the beginning of the period, and then we have a bunch of changes to the cash, whether we're spending cash or whether we're receiving cash, and then we end up with our ending cash. That would go on that ending balance sheet. So very similar to a statement of retained earnings, is just there's going to be more going on here, because cash is not just affected by net income and dividends, it's affected by a lot of other things. So I'm going to make the cash flow statement up here actually. Now cash flow statement, it's not at a specific point in time, it's for a whole period. So it's going to be for the month of November 2012. So I'll put cash flow statement. And then I'm going to make it over here. So what we want to do is we want to start with the cash at November 1st, 2012, which was what? 10,100. I had it written down. And now what we got to do is go through all of these changes here. So notice that when we bought the ingredients, that was a cash transaction. That affected the cash account. And because we're buying the ingredients, we're spending cash, that's a cash outflow. And so our cash went down. So that was a negative amount. And then we had this revenue of $7,000. That was cash that we received. That was an inflow. So that's going to be positive, $7,000. And then we had to pay the rent, which was $2,000. Then we had the interest we had to pay. So that's a cash outflow of $100. And then we had the utilities, also a cash outflow for $400. And then we paid down the loan for $700. That was a cash outflow. So that's a negative number. And then we paid ourselves a dividend, which also reduced cash by $900. And what happens, so that was all of the transactions that affected cash. Remember, this here was a non-cash expense because with the ingredients, the cash got spent up here when we capitalized the asset, and then we decreased the asset, and then that expense flowed onto the income statement. So we didn't spend $600 cash here. We bought the ingredients for $1,000. So that cash transaction with the ingredients was up there. So this was the only transaction that didn't affect cash. The rest did. And so what happens is if you were to net all of this out, you'd end up getting your cash balance for November 30th, 2012. And if you take 10,100, subtract 1,000, add 7,000, subtract 2,000, subtract 100, subtract 400, subtract 700, subtract 900, you would end up getting this amount here. And this here is that fourth financial statement, the cash flow statement. And as I mentioned, this here is very general. We're going to get into more detail, and this is only one of the methods to make the cash flow statement, where we're starting with the beginning cash, showing the changes, getting the ending cash is the direct method. There's also going to be another way, indirect method, where you start with the net income and then add and subtract a bunch of things. It's actually kind of weird to do it that way, but I'm going to explain it to you once we get there. So this is a general format of the direct method for the cash flow statement. And once we get into more details, there's actually going to be multiple categories within the cash flow statement. So notice I kind of just put these transactions here in the order that they happen. But an actual cash flow statement, you're going to see three categories for the direct method. You're going to see operating activities, you're going to see investing activities, and then you're going to see financing activities. So operating activities is within operations of the business. So like this revenue, and then these ingredients, and then paying this rent, interest, utilities, the actual business portion of it. And then we're going to have investing activities. There's no investing activities here from these transactions, but a good example of that is when we bought the machine initially. So that would be an investing activity. Basically, when you're buying long-term assets, if you're buying them with cash, that's going to be shown on the cash flow statement under that investment activity. And then the financing activities is more so stuff that's going to affect this right side of the balance sheet. So paying down this loan and taking this dividend, those are financing activities. Notice that these are cash outflows. We could also get cash inflows. So if we want to invest more money into this company, this capital account would go up. That would be a cash inflow. That would be a financing activity. That would be on the cash flow statement. If we take more debt on, so if we increase this loan amount, that would be a financing activity as well. But again, we're going to get into more detail on the cash flow statement, but just wanted to, my marker is running out. Interesting. Anyway, I wanted to just introduce a general format for the cash flow statement. So we're starting with that beginning cash with at the beginning of the period on the balance sheet, November 1st, 2012, and then we're showing the changes, and then we get that ending cash amount at the end of the period for November 30th, 2012.